The market just gave us a masterclass in human psychology disguised as a rotation. While everyone celebrates record highs, the smart money is quietly repositioning for what's coming next. The Russell 2000 just outperformed large caps for 9 straight sessions, the longest streak since 1990. This isn't bullish optimism. This is fear wearing a disguise. Here's what most traders miss. When indices hit all-time highs but participants flee concentration risk, the system is screaming that something fundamental has shifted. Today, I'm breaking down the 3-layer framework that reveals why this rotation is exploitable and how disciplined investors position for what happens next. The human layer tells the real story. Investors are caught between 2 competing narratives, the AI growth story that dominated recent years and an emerging recognition that 7 companies cannot carry an entire index forever. This creates cognitive dissonance. Participants simultaneously believe in technological transformation while recognizing the valuation risk in mega-cap tech. Fear of missing out has inverted into fear of being the last buyer. When the Magnificent Seven decline while 300 S&P components rise, the market is seeking diversification insurance. The homebuilder investigation and credit card rate cap proposals inject political risk into corporate decisions. This erodes the predictability premium that justifies elevated multiples. The Powell investigation introduces institutional risk. Markets tolerate uncertainty, but central bank independence is foundational. When the executive branch threatens monetary authority, participants must reprice the probability that interest rates become political tools rather than economic instruments. Gold's surge past $4,600 indicates participants are quietly positioning for regime uncertainty. The system layer reveals distribution within consolidation. Major indices printed back-to-back losses after touching all-time highs, a classic exhaustion pattern. The Russell's 9-session streak is a statistical extreme that typically precedes mean reversion. This breadth expansion during index weakness signals internal rotation, not broad-based strength. Energy emerges as the sole conviction trade. Oil's 7% rally on geopolitical supply disruption created momentum that captured $5 billion in energy flows since year start. This is defensive positioning. Energy outperforms during stagflation and geopolitical instability. The simultaneous decline in technology and financials despite earnings beats indicates multiple compression. The inflation data created a Goldilocks trap. Core CPI at 2.6% is the slowest since March 2021, theoretically supportive of rate cuts. Yet the Fed funds market prices only 2 cuts this year. This disconnect reflects participants understanding that the Fed's reaction function has shifted. Rate cuts now appear as capitulation to political pressure rather than data-driven policy. Commodity markets are pricing geopolitical fragmentation. Gold's move alongside oil's rally reflects simultaneous inflation hedging and safe haven demand. The Venezuela oil seizure and Iran tariff threats signal resource nationalism. China's ban on NVIDIA chips escalates technology decoupling. These are supply chain disruptions that create cost-push inflation independent of demand conditions. The Stoic approach recognizes what's actually happening. The market is revealing its true nature as a discounting mechanism for uncertainty. The rotation from growth to value, large to small, technology to energy represents participants reducing concentration risk and political interference risk. This is rational behavior when rules governing capital allocation become fluid. The Russell's outperformance isn't bullish for small caps, it's bearish for large caps. Participants aren't buying small caps because they believe in earnings power, but because they're reducing mega cap concentration exposure. This is defensive rotation, not growth rotation. The process remains unchanged. Identify where consensus is structurally mispriced, position for mean reversion, and manage tail risk exposure. The current environment offers asymmetry in volatility instruments, energy equities, and precious metals. Technology requires selectivity. Companies with pricing power and diversified revenue streams will separate from those dependent on capital expenditure cycles. The market is transitioning from a liquidity-driven regime to a fundamentals-driven regime where earnings quality and balance sheet strength determine survival. History shows humans consistently mistake rotation for strength and exhaustion for momentum. The system rewards those who recognize the difference. If you value systematic thinking over emotional noise, subscribe for frameworks that exploit predictable human behavior. Download the complete 3-layer analysis system in the description. It's designed for investors who understand that discipline creates edge while the crowd chases narratives.